This is Nightly Business Report with Bill Griffith and Sue Herrera.
Cruise control. Auto sales defy expectations and remain solid, despite rising interest rates and an escalation in trade tensions.
Summer heat. Home prices across the country are heading higher, except in the heart of the largest city in the country.
Rising risks. How Baton Rouge is battling extreme weather to keep its property protected. Those stories and much more tonight on Nightly Business Report for Tuesday, July 3rd.
And we bid you good evening, everybody. There was no shortage of news on this shortened holiday trading session. We begin with auto sales for June. This key economic sector has proven to be resilient despite growing storm clouds from those trade fights we've been telling you about. Americans are still buying cars and trucks at a strong pace, and that helped automakers close out the first half of this year with another solid month in the showrooms. Phil LeBeau has details for us tonight.
Call it cruise control. Auto dealers enjoyed steady demand in June, driven once again by consumers looking for pickups and crossover utility vehicles. That helped the largest automakers post positive sales last month.
Yeah, they look great, you know, and even as car sales have kind of collapsed, truck and SUV sales have more than made up for it. So the overall impact is still growth, and truthfully growth in higher profit vehicles. So it's still great news for the automakers, at least today.
For General Motors, which reported second quarter sales, the last 3 months show the automaker is succeeding in pushing pickup trucks and crossover utility vehicles. In the second quarter, GM's been able to push the average transaction price to a record high. The big question weighing on the auto industry, what impact will President Trump's push for higher tariffs on steel, aluminum, and potentially imported vehicles have on demand? For now, Germany's most popular brands are still seeing solid sales. But if the U.S. puts a 25% tariff on imported BMWs, Audis, or Mercedes-Benz, will buyers walk away instead of paying several $1,000s more for a particular model? Overall, auto tariffs could be the biggest threat to one of the best runs of strong sales the auto industry has ever seen. But the second half of this year could be a bumpy one for the auto industry, especially if new tariffs are put in place for imported vehicles, which could drive up prices in the showroom. Phil LeBeau, Nightly Business Report, Chicago.
Let's turn now to Jeremy Acevedo for more on the potential auto tariffs and what it might mean for the auto industry and, of course, for you. He's an auto industry analyst at Edmunds. Good to see you, Jeremy. Welcome back.
Oh, thank you so much.
We certainly don't know whether or not these tariffs are actually going to go into place, but let's, for the sake of argument, assume that they do. What net do you think the bottom line impact would be for the automakers?
You know, in all iterations of this, we've ran the forecast, and it does look like it's going to be a severe blow to automakers if these tariffs do come to pass. We're looking at sales diminishing potentially in the millions just because of how much of that cost is going to be deferred to shoppers.
Jeremy, I'm an old chess player. I'm always trying to think ahead to the next move. What's the next move in this whole situation here? I mean, obviously the objective is to get more production here to the United States. If there's enough pain, do you think automakers would do that?
Yeah, you know, I mean, I think that's one of those cases of this maybe potentially achieving the opposite of its intention. You know, this policy here that's aimed at increasing American jobs actually could, if you look at the cascading effects, reduce when you look at the reduction in sales and, you know, the hit to not only production but also the dealer networks.
Is there a number at which you think the consumer will pull back and say, no, I'm not going to buy that car? I mean, is it $1,000, $5,000, or do we know?
You know, I mean, shoppers right now are already operating at the very end of their budget. New vehicles in 2018 are costing shoppers upwards of $35,000. So there's not a whole lot of wiggle room they have left. When you look at the potential impact of these tariffs, and we're talking thousands that'll be passed on to the shoppers, anywhere from 2 to 8, you know, that's definitely going to dissuade shoppers from entering the market. So these will be significant, and it almost certainly will deter shoppers.
Does this hit the automotive industry overall equally, or are there certain automakers you could see being hurt more than others?
Everybody's going to feel the brunt of this. Even the domestic automakers will be impacted. They will be impacted less so, though, than some of their Japanese and especially the German counterparts. The German automakers do produce the most vehicles abroad comparatively.
Jeremy, thank you so much. Jeremy Acevedo with Edwards.
Of course.
Bill?
Well, on Wall Street, we had an early rally that fizzled by the close. Technology shares declined, offsetting gains in energy. Not surprisingly, trading volume was light during this shortened session ahead of tomorrow's 4th of July holiday when, by the way, the markets will be closed. But by the close of trade today at 1 p.m. Eastern Time, the Dow Industrial Average fell by 132 points to 24,174. The Nasdaq was down 65 and the S&P 500 dropped by 13. As for the price of domestic crude, it topped $75 for the first time since 2014 and then fell sharply on a report that Saudi Arabia is ready to add more oil to the market to end the day little changed.
Factory orders rose in May, easily exceeding an expected decline. New orders for U.S.-made goods increased 0.4%, pointing to a strengthening of the manufacturing sector. But the report also showed that business spending on equipment is slowing, or rather is showing signs of potential slowing.
Meantime, the rate of job growth and wage increases at small businesses dropped in June. This is according to a new study from payroll company Paychex. 65% of respondents said that they were not planning on giving raises to their workers because profits were not high enough. And this comes at a time when Main Street is having a hard time finding workers.
We're seeing that these small businesses are struggling a little bit more to be able to attract the employees that are out there in this tight market. I do think it'll give, but we have not seen it yet. It's still below 2.5% wage increase, which is very interesting at this point given that market.
The report did say that optimism is at elevated levels, but it's just not yet translating into higher pay for workers.
To housing now, where there seems to be no relief to the hot summer market. Diana Olick has the details of a new report.
As the mercury soars, so do already overheated home prices. The latest read shows values in May jumped over 7% compared to a year ago, the biggest annual jump in 4 years, according to CoreLogic.
I don't see it really slowing appreciably over the course of the next year. A little moderation in national home price growth, but not much. We're forecasting a 5% rise in national home prices over the next 12 months. So a little moderation, but not much at all. That's still much better than inflation overall.
The supply of homes for sale has been shrinking for 3 straight years, and it's not all the home builders' fault. They are increasing production, although slowly. Part of the shortage is being caused by current homeowners. About a quarter of potential buyers who already own said they will not move if the interest rate they get on their next mortgage is 1 percentage point higher than what they have now.
Half of all homeowners with a mortgage today have a rate of 3.75% or lower. And so when they're looking at a 4.6% rate, they say, well, maybe I'll stay put in my home a bit longer. And that's constraining some of the supply coming from the existing inventory.
During the recession, the average rate on the popular 30-year fixed fell well below 4%, and it's now inching closer to 5%. Millions of homeowners refinanced to those rock-bottom rates, and the idea of not just a higher rate, but a competitive, pricey house hunt ahead doesn't exactly give those owners a push out the door.
And on top of that, those who should be heading out the door and downsizing, that is baby boomers, are not. They're taking their sizable home equity and using it to stay put.
Boomers, on the other hand, have been saying, look, we intend to age in place, and we're going to remodel a house because we want the kids to come home and bring the grandkids. And they're doing that. So the ratio of existing homes for sale relative to our demographics is at 30-year lows.
Which means home prices really have nowhere to go but up. For Nightly Business Report, I'm Diana Olick in Washington.
However, the opposite is true for one of the country's bellwether real estate markets. That would be Manhattan Island in New York City. It just turned in its worst second quarter since the financial crisis. Robert Frank explains why.
It was the third straight quarter of declines for Manhattan real estate. Prices fell, sales declined, and inventory rose. The average apartment in New York City will now cost you a mere $2.1 million. That's down from around $2.2 million last year. according to a new report from Douglas Elliman and Miller Samuel. Now, the number of sales fell 17%. The high end is still the weakest, especially new condo buildings. Sales for new developments plunged by 37%, and there's now a 15-month supply of luxury units. Now, there are three main reasons: the growing pipeline of new condos coming onto the market, the new tax law, which makes buying a home in a high-tax state a little less attractive, and fading foreign buyers. The share of apartments being purchased by foreigners has fallen by 40% since the peak in 2015. Overseas economies are slowing, and governments are cracking down on using real estate for money laundering and offshoring. Now, the most expensive sale of the quarter in Manhattan was a penthouse of the new Getty building on 24th Street off the High Line. Private equity billionaire Richard Smith paid $59 million for a 10,000 square foot, two-story penthouse plus the floor below. It's got 2 master suites, 4 other bedrooms, 7 baths, and 2 kitchens. For Nightly Business Report, I'm Robert Frank.
Meantime, U.S. retail vacancies are on the rise, and the reason is not a surprise. Brick and mortar stores are closing as more people shop online, but the trend is taking a toll. According to Reese, a real estate research firm, malls haven't been this empty since 2012. That is creating a headache for the commercial real estate market, even as the economy strengthens.
Time to take a look now at some of today's upgrades and downgrades. We begin with Pepsi, which was downgraded to hold from buy over at Deutsche Bank. The analyst there cited valuation, given the stock's 12% rise over the past 2 months. Price target now $116. That stock fell a fraction to $108.80 today. A different analyst at Deutsche Bank downgraded a number of airline stocks, including American Airlines, to hold from buy. The firm said that the sector typically underperforms the market during periods of heightened geopolitical risk, in this case, the trade tensions. Price target now 43 on American. Shares fell more than 1.5% to $37.75. And that analyst also downgraded shares of Delta and United to hold for the same reason. And separately, Delta today did acknowledge that rising fuel prices will impact its second quarter earnings.
Roku was upgraded to outperform from perform over at Oppenheimer. The analyst cites the rapid increase in time spent on its Roku channel just 9 months after its launch. The price target is $50. The stock was up about 5% to $45.54. Square's price target was raised to $74 at Susquehanna. The analyst cites good fundamental trends as well as the Weebly acquisition. Weebly is a website builder. The rating remains positive. The stock fell nonetheless by 2% to $61.75.
Still ahead, should Medicare allow some patients to buy into so-called concierge medicine? That's coming up on Nightly Business Report. Glencore has received a subpoena from the Justice Department. Officials are asking for documents related to potential corruption and money laundering. Glencore mines commodities like copper and coal and then trades those materials. Shares of Glencore trade in London, where they were down sharply today.
Facebook is facing a broader investigation into its sharing of data with Cambridge Analytica. The social media company has received questions from the SEC as well as the FBI. The Justice Department and the FTC are already looking into how Cambridge Analytica purchased data on 87 million Facebook users without their consent. Facebook says it is cooperating with officials. The stock fell more than 2% in today's session.
Amazon's next Prime Day is going to be run longer than ever. It kicks off July 16th at 3 p.m. Eastern Time, and it will go for 36 hours. Last year, Amazon generated an estimated $1 billion in sales on Prime Day, which, as you may know, offers deep discounts on thousands of items to its Prime subscribers. Meantime, others are also offering deals. Rivals like Target and JCPenney will early up their back-to-school sales, and eBay plans to offer thousands of exclusive deals on July 17th.
The second half of the year is a key time for the retail sector. So what can investors expect in the months ahead? Courtney Reagan takes a look.
For retail, it's all about the second half of the year. And in 2018, a trade war threatens to curb a strong consumer spending trend. From the summer on is where you'll find the three biggest online shopping holidays: Amazon's Prime Day in July and Black Friday and Cyber Monday in November. Analysts predict Prime Day will play a big part in back-to-school sales for many parents, though some wait until the fall. No matter when the spending occurs, analysts predict the prolonged school spending season will continue a strong retail cycle that began just after last year's back-to-school season ended. Then once school's in session, it's time to deck the halls for retailers. But last year's holiday spending was stronger than expected, making the bar higher this year. Plus, as President Trump, China, and Europe threaten tariffs, holiday sales could end up a trade war casualty. Retail lobby groups say tariffs are a tax paid ultimately by consumers because it increases the price of goods. If Americans do pay more for goods in the second half of the year, that could cut down on sales. So tariffs could be the Grinch that steals Christmas. For Nightly Business Report, I'm Courtney Reagan.
Pfizer is raising drug prices for the second time this year, and that is where we begin tonight's Market Focus. After hiking prices back in January, the pharmaceutical giant is now saying it plans to raise costs nearly 10% on more than 100 prescription medicines. Pfizer also noted that a handful of its treatments will see a price cut as well. Pfizer shares were up a tick to $36.35. Activist investor Dan Loeb is reportedly urging Campbell's Soup to consider selling itself because he believes that company is undervalued. The New York Post says that Loeb's hedge fund Third Point is in talks with investors and family members of Campbell who hold a minority stake. Shares rose nearly 2% to $41.03. And Colgate is reportedly seeking the help of a subscription service company to sell its products. The Wall Street Journal says the consumer products giant is nearing a deal to take a minority stake in online contact lens company Hubble. Colgate and Hubble would then jointly offer a subscription service for Colgate's oral care products, and then it may expand into other categories at a later time. Colgate shares rose a fraction to $64.67. Finally, Unilever said that it has completed the sale of its food spreads business to global investment firm KKR. That deal, which was announced last year, is intended to help Unilever focus on its stronger growth areas. Shares of Unilever were up more than 1% to $55.77. Sue?
Bill, the lighting company Acuity brand said strong demand for its infrastructure and utility products helped sales rise and top estimates. Profits fell, but they still came in well ahead of expectations. The shares popped more than 12% to $132.05. Micron Technology says it has not yet received an injunction halting sales in China. Earlier today, Bloomberg reported that its rival United Microelectronics said a Chinese court had temporarily banned Micron from selling hard drives and memory sticks after United Micro filed a patent infringement lawsuit. Shares of Micron Technology fell 5.5% to $51.48. We told you last night that Axiom was close to reaching a deal with ad company Interpublic Group. Now it's official. Interpublic will pay nearly $2.5 billion for Axiom's marketing solutions business. Axiom said it would use the money to trim debt and to add to its stock buyback program. Axiom shares jumped 15% to $39.45. Meanwhile, Interpublic fell 3% to $22.33. And Tesla shares continued to fall today after a report the car maker eliminated a brake safety test during production of its Model 3 vehicles. Tesla said it felt the so-called brake and roll test was redundant, as it already puts each car through a rigorous quality check. Shares nonetheless were off 7% to $310.86.
Last night, we told you about concierge doctors. This is a growing trend in healthcare where physicians charge customers a fee up front for unlimited access to primary care. Such a service has long been considered a luxury for the rich. But as Bertha Coombs reports now, the Trump administration is considering whether Medicare should allow some patients to buy into these kinds of practices.
She's going to ask now questions.
Tim O'Connor dedicates his time in retirement to teaching English and keeping on top of his health.
I don't have a great cardiac family history in my family.
When his doctor converted to an MD VIP concierge practice with a $2,100 annual fee per person, Tim and his wife decided to buy in.
Is money a consideration? I don't want to say it's not a consideration, but I do believe in preventive medicine.
The fee gives them unlimited access for same-day appointments, longer visits, and a comprehensive annual physical. For their doctor, it means being able to provide more personalized care to about 500 patients, about a quarter the size of his old practice.
If somebody has 3, 4, 5 different conditions, it's almost impossible to see them within a 10-minute period. So you have the time to sit down with them, direct them in the right direction, and I don't know how you can do that in the traditional model.
Concierge medicine has been around for decades, but the membership model makes up less than 10% of physician practices because many patients can't afford it. But now the Trump administration could give some of these fee-based practices a boost.
Health Department Secretary Alex Azar has proposed possibly giving some Medicare patients a stipend to help them gain access to fee-based practices with more personalized care. Medicare has been looking for ways to pay doctors for better outcomes rather than for the number of procedures they perform. The CEO of MDVIP, the nation's largest concierge medicine business with nearly 150,000 Medicare patients, is watching the proposal closely.
We save Medicare hundreds of millions of dollars a year by avoiding things like ER visits, hospitalizations, readmissions to hospitals. So the elements of a more direct provider contracting model certainly works and works well.
Tim O'Connor is convinced paying for prevention has paid off in better health.
We have saved more over the years if we were to sit down and try to figure out the economics of this by staying with Dr. Zeal.
It's not clear how the administration would structure a stipend program. Some critics worry it could just drive up costs for primary care. Right now, the health department has just asked the industry for comments. In the months ahead, it will likely propose a pilot program to test the concept. For Nightly Business Report, I'm Bertha Coombs in New York.
Coming up, rising risks to real estate, how one city emerged from devastating floods to lead the battle against extreme and costly weather damage.
Two years ago this summer, a massive rainstorm stalled over Baton Rouge, Louisiana. It flooded the areas and caused billions of dollars in damage to both residential and commercial real estate. Ironically, Baton Rouge, which is on the edge of the Mississippi River, is now fast becoming a research hub for the study of rising water. Diana Olick is back with us tonight with the next part of our series called Rising Risks.
It was a freak storm, dumping over 2 feet of rain on the Baton Rouge area. Rivers swelled, flooding more than 100,000 homes, nearly $4 billion of residential property damage alone, according to Louisiana Economic Development. Justin Aaronworth is CEO of the Water Institute of the Gulf.
What we're doing now is to be better prepared, using science to better prepare ourselves for that next flood.
Ironically, as the rain came down in 2016, a $60 million project in downtown Baton Rouge was going up, a water research center called the Water Campus, home to the just opened Water Institute of the Gulf.
There are ways to use the best available science to better prepare, to better respond, and to be able to get assets and people out of harm's way.
And also to better build.
And to better build.
This as Baton Rouge is in the midst of a building boom. The number of construction permits nearly doubled in the last 5 years, according to the Downtown Development District. John Davies is a local developer and also CEO of Baton Rouge Area Foundation, which is helping to fund the water campus.
If we don't deal with the issue of water rise and the loss of land in South Louisiana, there will be no South Louisiana.
Davies claims the institute is already paying off, not just for Baton Rouge, but for communities, infrastructure, and economies up and down the Mississippi River.
What we didn't realize, but what happened as a result of the floods, is that the Water Institute of the Gulf developed a methodology to be able to predict inland flooding. And they have the sole model to do that in the country.
And just next door, another unique weapon in the battle with water, a giant Mississippi River simulator, the size of 2 basketball courts.
We harness the power of science to figure out how can we build structures, how can we build new wetlands and new barrier islands that will help protect properties and infrastructure along the coast so that when the next storm comes, you've got buffer.
Jeff Hebert was the chief resilience officer in New Orleans before joining the Water Institute.
The flooding that happened in Baton Rouge happened in areas that are more newly developed and areas that were built on what's probably you would call the natural drainage system of a community.
It is a risk repeating itself in growing urban centers anywhere near water.
I do think that with Hurricane Harvey in Houston and all the destruction you saw in Puerto Rico and the threats that Florida faced and had near misses every time last summer, I think that really woke people up a lot, and you see more discussion about what can we do to prepare for what's happening today.
In May, the campus hosted its first international conference on water, drawing more than 200 experts.
This science is taking place in Baton Rouge, and we're exporting it around this state, across the Gulf of Mexico, and all over the world.
Do you expect to see more of what we saw in Baton Rouge 2 years ago?
We are preparing ourselves for the worst.
For Nightly Business Report, I'm Diana Olick in Baton Rouge.
And to read more about the rising risk to real estate in Baton Rouge there, you can head to our website at nbr.com.
And before we go, let's take a final look at this shortened trading day on Wall Street. The Dow fell 132 points, the Nasdaq was down 65, and the S&P 500 dropped 13. And that will do it for Nightly Business Report tonight. I'm Sue Herrera. Thanks for joining us.
I'm Bill Griffith. Have a great evening, everybody. Be sure to join us tomorrow for a special 4th of July edition of NBR. Good night.